Welcome back to the Economic Analyst channel. In this video, I'm going to give you an update that I wrote a while back toward the end of 2022 about the state of the U.S. economy. Now, I wrote a report back in the middle of 2021 and also loaded that up into my video feed for YouTube back in, I think, about late 2021 about some of the more details of the analysis that I have been conducting on the status of the U.S. economy. Back last year, I thought it prudent to give an update, and I thought it would be wise to upload this to YouTube so that way we could derive insights from it. So without further ado, let's begin. So the state of the U.S. economy. In the wake of the worst price inflation crisis the U.S. has seen since the 1970s, governments and central banks have largely reacted much as I expected. Government leaders have largely ignored or flat out denied the underlying causes of this inflation, while central bank leaders begrudgingly acknowledge the problems and have started to take measures accordingly to counter the systemic price increases. However, neither side has admitted that their policies are the cause for this crisis, and even worse, that their current policies have laid down the foundation for the next crisis. The causes of this inflation crisis were twofold. First, the shutdown of major production and distribution of goods during the global COVID pandemic destroyed the supply chain, and as existing stock inventories were consumed without being replaced, these shutdowns created shortages, delays, and disruptions in the transmission of new goods to market. Second, and most critically important, currency and new loan creation driven by government stimulus measures designed to replace lost incomes from government-mandated shutdowns facilitated the continuous price increases, as more and more money chased existing goods supplies and increased faster than the rebounding economy could accommodate. The chart below shows the strong correlation between increases in the money supply, which is the blue line, and increases in consumer prices, that is the red line. While the money supply increased by 50% in the last 3 years, consumer prices increased by 15%, and will increase even further during 2023 by at least 6%, even as money growth has stalled. This is because, while money growth has flattened in 2022, aggregate debt growth has not. Since 2020, total U.S. debt has increased by $14 trillion, nearly 20%, as consumers and producers have been forced to compete with the U.S. government for finite resources. These fundamental pricing pressures will cause price inflation to stay elevated longer than it has to be and complicate the economic recovery. What has prevented consumer prices from spiking even farther has been the rising value of the U.S. dollar and the Biden administration's dumping of oil onto the market from the U.S. Strategic Petroleum Reserve. This strengthening of the U.S. dollar has occurred in large part because of foreign capital inflows from Europe in the wake of the Russia-Ukraine war. European public and private entities, desperate to park their wealth in some kind of safe asset with a return, have bought U.S. treasuries, despite the Fed sharply raising interest rates at the fastest pace we've seen in 30 years. My original premise was that international investors would purchase precious metals, but instead they have foolishly bought U.S. government bonds at a time when bond interest rates are climbing and providing negative real returns for holding them. As for the oil supply, the Biden administration has unloaded 2/3 of the U.S. Strategic Petroleum Reserve supply onto the market, drastically reducing gas prices in an attempt to staunch the rapid rise in consumer prices. Meanwhile, interest rates have soared in corporate bonds, government bonds, mortgages, and consumer loans. Real median wages have collapsed from higher consumer prices, and more expensive borrowing costs have reduced the real standard of living for millions of Americans. At a time with historic debt to GDP levels and overvaluations in the stock market caused by money manipulation and record artificially lowered interest rates, the degree of malinvestment in the economy suggests that the coming economic crisis developing from these rising interest rates will be the most severe recession the U.S. will experience since the Great Depression. While the stock market is guided by interest rate valuations, the coming recession will deflate the stock bubble as past recessions have done, and the stock market will collapse from record nosebleed territory. In the meantime, Precious metals largely underperformed during this inflation crisis, rising initially at the onset of monetary stimulus in 2020, but since flatlined. The overvaluation in the stock market and reluctance of market participants to purchase precious metals versus treasury debt suggest that they will continue to underperform in the economic cycle until the recession sets in and the Federal Reserve will be forced to initiate another round of bailouts with fresh monetary stimulus. The timing of the credit collapse that will lead to the next recession is up for debate. In my last report, I predicted that 2023 to 2024 would be the likely scenario. Since then, the yield curve, a near perfect predictor of economic recessions, using the 30-year Treasury rate and the federal funds rate, is approaching an inversion. Given the lag time between yield curve inversions and economic recessions, the anecdotal data strongly points to a 2024 recession. In addition, the federal deficit has widened drastically, caused by record levels of government spending, as the Biden administration has desperately tried to spend and print their way into prosperity. This will put further upward pressure on interest rates and exacerbate the economic crisis, as the dollar itself may be put in jeopardy from the rising debt loads and interest payments. Drastic cuts to government spending will be needed to stabilize the fiscal imbalance, cuts that I do not believe Congress will perform, even if every politician were a Republican. The nasty history of Republicans cutting taxes, blowed up military spending, and widened deficits is almost as disastrous as Democrats raising taxes, blowed up welfare spending, and widened deficits. One road leads to the cliff a little sooner than the other. I do not wish for these things to happen, which is why I'm writing this report. I pray that I'm wrong. Thank you guys for watching and listening to this report, and I promise I will provide more timely updates in the coming future. Once again, this is the Economic Analyst. Thank you for watching this video.